The biggest news in the housing market this week is that the Biden administration has announced that we're in our final month of the mortgage forbearance foreclosure moratorium. There are still a couple million homes in the mortgage forbearance program. And as these homes transition back to paying their mortgage after 15 months, what's going to happen to them? Do we finally have a wave of foreclosures that are going to spiral the housing market out of its bubble? That's what we're going to look at this week in the Altos Research Real Estate Market Report. Every week, Altos tracks every home for sale in the country, all the prices, all the supply and demand metrics. And it turns out that this data tells us a ton about prices and sales that will happen several months out into the future. If you have a hypothesis about the residential real estate market, that it's going to burst, for example, and spiral downward, or maybe that it's going to keep surging, or maybe you think buyers are out of steam. So this is how you validate that hypothesis. The key to answering the question of how many homes are likely to hit this foreclosure process once the moratorium is lifted, the answer is in the demand metrics. It's all about demand. So it's Monday, June 28th, 2021, and this week we're going to look at demand metrics. The median price for single-family homes in the US is unchanged this week, again at $399,000. As we've been pointing out all month, this seasonal plateau is totally normal. Many years the plateau goes from June into August. Next week after the July 4th holiday would be the first time a possibility for a dip. We'll have less new inventory come to market over the holiday. Last year, prices actually ticked up in July and August, and not by a huge amount, but compared to normal years when prices are receding, it made the year-over-year comparisons look very strong. So we're currently at 14% home price appreciation over 2020. That percentage should compress a bit through the second half of the year as 2021 is back to its normal seasonality. So I can imagine 2021 ending with a 12 to 14% price gain on single family homes. The leading indicator, the price of the newly listed cohort, is also unchanged this week at $365,000. This shows us that already the demand is there in the market and sellers know it. So the instant demand weakens, the price of the new listings starts to adjust down. For reference, see the summer of 2018 here, the dotted line here is staying elevated late into the summer this year, where in 2018 it receded quickly in the second half of the year as mortgage rates were rising. You can see the demand backing off in this price of new listings. So this is signal number one that housing demand is still elevated this summer. Signal number two is this metric, the percent of listings with price reductions in the last 90 days. So this is an annualized view here that shows us the yearly cycle. Later in the year, if your house is still on the market, you cut the price to move it before the holidays. The fewest price cuts are needed each year in March because that's when the most good inventory is listed. So there are two remarkable things to notice on this chart. The first is that you can really see how that remote work, remote school pandemic year kept demand elevated all the way through the holidays of 2020. If my kids aren't in a physical classroom, I can move house in December if I want. So that's this green line here, staying low, fewer price reductions well into the year. The second observation is that even as strong as demand was in November and December of last year, demand actually accelerated in January and February of this year. Price reductions were even fewer this year. So you can see now in this, the bold red line here, that we're past the biggest of the pandemic distortions. We're now on a more seasonal curve. Demand is lightening up for the summer, but we can also see that this winter will not be a repeat of last year. However, because we're coming off this ultra high demand, we're down to merely very high demand, and so we're not, but not weak. We're very high demand, but not weak. I read this week a hedge fund that had raised a bunch of money to buy all the foreclosures that they expect to come to out of the pandemic when the moratorium is lifted. What this fund fails to realize, of course, is that their competition is every family in America. As soon as just a little weakness peeks in, price reductions happen, and boom, those properties are getting snatched up. So leading up, for example, to the crisis of 2008, price reductions, this metric was over 45% nationally, 55% in the hardest hit markets. 55% of the active stock is taking price cuts because there's no demand. So before you start planning for some kind of self-reinforcing downward cycle, you should watch this price reductions number climb to at least 40%. My expectation is that we'll probably get back into the mid-20s this year. Okay, signal number 3 for demand in this crazy hot market: the time to sell the house. The median days on market for all properties in the US is still just at 21 days. Market time starts climbing each year in August as the summer comes to a close. Here again, you can see this unusual demand of 2020 where DOM actually fell in the third quarter. But we're back to normal seasonality, just way stronger than normal seasons. The market time is a critical factor often overlooked when forecasters are trying to understand the likelihood of foreclosures. The psychology works like this. I need 3 factors to be true in order to make that difficult decision to walk away from my home and let it go into foreclosure. 1, I need to expect that I will never be able to afford this mortgage again. That means I have to expect that my job prospects are really bad. 2, I need to be upside down on my mortgage. I need to owe more than my house is worth. And 3, I need to expect that I'll never be able to sell this house. I can't get out of it. That's when I walk away. All 3 of these need to be true in order for me to go into foreclosure. I can't afford it. I'm already upside down, and I can't unload it. I argue that right now, none of those 3 are true for almost anyone in the country. There are people whose lives change permanently and they can't afford the mortgage. There are those people, but home values climbed 15% in 2020, another 14% in 2021. We have record equity and it's growing every day. So if everything else in your life was destroyed this year, if you're a homeowner, you made a ton of money on your mortgage, on your home. So that's not just something that we walk away and hand to the bank, because the worst case scenario is that if you are one of these few most unfortunate folks, the worst case scenario is that you sell your house in 3 weeks, like before your next mortgage payment is due. And that is why demand is the factor to understand when predicting future foreclosures. But wait a minute, some folks cry. Won't this big flood of listings increase the supply and then drive down prices? Can that create a downward spiral? That downward prices, less equity, more pressure to sell. So the answer is yes. at some point there'd be too much supply. But if you've been with us this year in these videos, you'll know that supply is so tight that we'd need to double or triple, really, available inventory to get back to even normal levels. Active inventory of unsold homes ticked up this week to 359,000. But peak inventory is early August usually, so the shortage crisis is not going away this year and probably not going away next year. But even if a few 100,000 homes out of the forbearance process came to market, we'd still have a shortage. Of the 7.2 million homes that were in the forbearance program all year, 17% have been paid off fully, mostly because they sold. There are about 365,000 in the loss mitigation part of that process right now. It's very tiny. So that's all for this week. The summary is demand is very high and it's waiting to swoop in for any opportunity. Demand would likely weaken if mortgage rates rise substantially. However, to get any wave of foreclosures, that demand would have to weaken well before the moratorium ends to cause any of the negative amplifying effects. So as of right now, demand for homes in the US remains really as strong as we've ever seen it. And therefore, no foreclosures are forthcoming. So that's all for this week. More next week. Please subscribe to the YouTube channel to stay in touch with the videos, and come to altosresearch.com if you need the data in your real estate business or to understand your forecasting for your big hedge fund that wants to buy foreclosures. Thanks, everyone. More next week.